At the risk of sounding like a broken record, I continue to advise caution in the stock market. Right now, there seems to be a dogfight as the S&P 500 remains below its 200-day moving average. A move above or below the 200-day moving average is often used as a proxy for changes in an asset's long-term trend. This is always closely watched by investors, but with the S&P 500's long relationship with that key level, and as the S&P 500 has bounced back from its bear market plunge, the relationship has become more of a fixation. So, let's take a look. Even if stocks make it back above the 200-day, history indicates that an extended run to the upside is not guaranteed. And with the close of the market on Friday, the S&P 500 is at 2955.45, or just a kiss below 3000. Who would have guessed? From the March sell-off ending around 34% below the all-time high, we have bounced back by 35%, and we are only about 9% from the all-time high. As we find the S&P in the twilight zone below the 200-day moving average and above the 50-day moving average, investors feel trapped because we've been here for 21 straight sessions. But don't get your hopes up too much. Since 1928, there have been 29 similar streaks that have stretched to at least 20 days. 21 of them ended with the S&P 500 falling below the 50-day average, while only 8 ended by pushing above the 200-day. That indicates a rough 72% probability the S&P will break down. So let's go to our charts and see what they indicate. And we're looking at the 6-month daily chart on the SPY, the Spider's S&P 500, and the close on Friday was 295.44. There has been a general uptrend in the last, say, month or two, which is good. But moving down here into the volume, you can see that that recent peak there, subsequent to that, we've been downhill, and that's not a good sign. Now, we have a mix of indications in the oscillators, and so here we go with the MAC. The MAC fast line and slow line have been moving together, say this last month or so, and that's why the price chart has a general uptrend. It's good because it's above zero. Here into the MAC, you see the same thing, the histogram rather, and then here into the price rate of change, also moving sideways more or less for the last month or so. So nothing committed up or down. It is slightly above the zero line, which is good. Relative strength, same thing. Trending sideways, slightly above that 50 or midline. Again, that's good. So a lot of these oscillators are showing some slight favorable conditions, including the stochastics with that bottom here, and then move on up into that overbought territory. Hopefully it stays up there, but it can crest and come on down. Here into the Williams, pretty much the same. Bounce, move on up. We're in that overbought territory, but could it crest? Well, we're not quite sure. So we have a mixed bag of indications from the oscillators here, back to the price chart. Now, as I've told you in several videos, the VIX as well as the VVIX are both looking like they want to base here. Now, the VIX is basing near 30, and that is well above where we want to be. You want to see the VIX under 20 in the teens, but it's stubborn and it stayed above 20 for quite some time in that striking distance of 30. And that could cause problems very easily here in the near future. If it wants to spike up, that's going to cause the volatility and then a contraction in the markets. Now, it doesn't necessarily mean that we're going to crash or even test that previous low, but it does mean that there is a potential for a contraction. And so that's why I want you all to remain cautious and prudent. And for today, that's ChewDog Charts. Thank you.